Welcome, curious minds, to another deep dive. Today, we are digging into a really fascinating intelligence briefing. It pulls back the curtain on some big market-moving events coming up. It's all about seeing the signals, figuring out how to size your trades, and knowing, exactly where you might need to tweak your strategy. We've got this report in front of us. It's called Inflection Week Ahead, and it really zeroes in on three major events that look set to steer money flows. We're talking stocks, crypto, gold, currencies, everything. The source actually says, and this is a quote, "Breath is being held, and for good reason."
Hmm.
So our mission, like always, is to help you unpack why that breath is being held, give you that edge.
Yeah, and what's really compelling, I think, is how these events, you've got the Treasury's quarterly refunding, the QRA, then the FOMC meeting, and key data like non-farm payrolls, GDP, look separate, right? But they're not. They're
Yeah.
deeply interconnected. They create this powerful ripple effect across all sorts of assets. Understanding how each one works is just crucial if you want to grasp the bigger picture. Market liquidity, investor sentiment, all of that.
Okay, let's unpack that first big one then. The Treasury's quarterly refunding announcement, the QRA. It sounds technical, maybe a bit dry, but the briefing insists this is actually a massive indicator for market liquidity. And that means for your portfolio, too.
Exactly. At its heart, the QRA is just the Treasury's plan for the next quarter, how it's going to borrow, how it's going to manage its cash balance. But the big idea, the key insight from our source, is that shifts in this plan aren't minor tweaks. They can actually kick off multi-week trends across, well, pretty much everything. It's foundational.
The report uses a great analogy. It says, think of the markets like a big swimming pool. If the Treasury issues more short-term bills, it's like adding water to the pool. More short-term liquidity. Simple enough. But if they issue more long-term bonds, that's like draining water out, capital being pulled from the markets. It even points to a past example where a surprise cut in bill issuance slammed stocks in crypto. Really shows that ripple effect.
Which brings us to, okay, what should you actually be watching for? What are the specifics? The report flags two key things. First, the mix. Is it more bills or more bonds? That gets announced on announcement day, usually Wednesday. Second, and just as vital, is the follow-through. What happens to prices, especially S&P 500, Bitcoin, the dollar index over the next, say, 1 to 2 weeks? Does the market confirm that initial reaction?
Okay, so putting that together, what's the actionable advice here for someone trying to navigate this? The report is pretty clear on this. It says, basically, stay small leading into the announcement. Don't take big bets beforehand. If the QRA comes out bill heavy, more liquidity, it suggests maybe adding to long global equity positions. But if it's bond heavy, draining liquidity, the advice is tighten your stops on longs. And maybe even think about some risk-off hedges. It's about being ready for either scenario, right? Not getting caught flat-footed.
Yeah.
Okay, so the QRA handles the liquidity side. But what about the bigger market mood, the sentiment? And those cycles traders try to catch. That takes us to the next big event, the FOMC meeting, the Federal Reserve. Now, our source thinks we probably won't see immediate rate cuts this time, but the statement from the Fed, that's absolutely crucial. It'll reset expectations, and maybe more importantly, it kicks off a whole new 6-week trading cycle.
Yeah, this 6-week cycle concept is it's pretty neat. The report lays out these specific cycle rules for trying to time your trades within it. It suggests marking the high and low prices on daily charts, starting from the last Fed meeting up to this upcoming one. Then you draw levels across that range. 0%, 25%, 50%, 75%, 100%. Standard FIB levels, essentially, but applied to the Fed cycle range.
And the strategy here is actually quite clever. It's about scaling in or out as the price crosses those levels you just drew. And here's a really key bit, a pro tip, the report calls it. Avoid making big new trades in the 7 days before the FOMC meeting. That week is apparently for protecting profits you already have, not for chasing new moves or adding big risk. Seems like solid advice people often ignore.
Oh, absolutely. It's tempting to trade the anticipation, but the report advises against it. And connecting this cycle idea to real assets, the report gives some examples. Like for AUDJTY, from the last cycle, it was suggesting maybe sell some below 95 or look for a gap fill near 96.84. For Bitcoin, if you bought around, say, 104K or 99K, the advice was sell some below 116K, move your stops up, protect those gains. Dollar pairs, it noted, were a bit less clear, though USD, it suggested, might push over 1.18 depending on how the QRA, yields, and stocks all interact. And this current week, leading into things, it noted was showing slow upward moves, like in the S&P 500, kind of a holding pattern.
So we've got the QRA liquidity switch, the FOMC cycle reset. Now the third piece, non-farm payrolls and the Q2 GDP data. Our source calls this the moment that delivers the market's growth verdict. Big stuff.
Exactly. And the report lays out pretty clear scenarios. For GDP, if it actually shows the economy shrank, well, that confirms a recession is likely here or very close. That puts huge pressure on the Fed. On the flip side, strong GDP. That probably means the Fed sticks to its data-dependent pause, no rush to cut rates.
And the non-farm payrolls, the jobs number. A miss, meaning weaker job growth or rising unemployment. That would signal the Fed's bias should turn dovish, right? More likely to cut rates soon. But a beat, strong job growth, that suggests the current risk-on mood in the markets probably stays intact. So you can really see how each data point kind of pushes the Fed and the market one way or the other.
Right. So the plan, the tactical approach outlined is maybe pre-position a small bias based on what you gleaned from the QRA and the FOMC tone, just a small one. Then use the NFP number itself as the catalyst. Time to reassess your stop levels. If it's a beat and helps your position, maybe widen your stops a bit, give it room. If it's a miss and goes against you, tighten those stops right up. Protect your capital. And definitely expect some fireworks volatility spikes in the first 30 minutes after the NFP release. Markets will be digesting it fast. This links right back to those risk-off swings we talked about with the QRA.
Okay, so we've covered the big three drivers. Now let's zoom in. How does this actually play out across different assets? Equities, crypto, gold, currencies. This is where we get some really concrete takeaways. First up, global equities. The S&P 500 is the main focus. Our source points out something interesting. While the S&P has been strong, a lot of systematic traders, the algorithm-driven funds, they only really jumped into the rally at higher levels, around 5,800, 5,900 maybe.
And that's not just trivia. It's actually a potential vulnerability. Their positions are more exposed now. If that QRA doesn't deliver the expected liquidity boost, well, you could see forced selling from these systematic players, bigger liquidations. That could cause sharper pullbacks than people might expect otherwise. And the report notes, sometimes this hits fast, within hours. Other times it takes maybe a week to fully play out. That timing difference is key.
Right, and Bitcoin, crypto, always volatile, always interesting. The report flat out links QRA liquidity shifts to Bitcoin's moves. No surprise there, really. And it reinforces using that 6-week FOMC cycle to try and time buys near potential lows. It even hints, just hints mind you, that altcoins might start a 2021-style rally in August, but probably choppy at first before a clear trend sets in.
Turning to gold. The report mentions being long from around $3,280 an ounce, but with clear need to protect that. So selling below $3,390. The hope is for a break above $3,450 for more upside. But the core advice, no new buys until after all these big events are done and dusted. Let the dust settle first.
Okay, next, yen and the Nikkei index. This is fascinating. The source asks, why are yen pairs rising with yields? Usually you'd think higher global yields might weaken the yen as a safe haven.
It's a great question, and the report offers an explanation. It's actually about rising Japanese yields. Why are they rising? Well, more government borrowing in Japan, less bond buying by the Bank of Japan, the economy doing okay, some moderate inflation. Put it all together, and investors are looking for better returns there, shifting away from safe haven bonds, connecting that to the bigger picture. This helps lift yen currency pairs and the Nikkei stock index. The Nikkei's even potentially eyeing new all-time highs, like 41,212 or maybe 42,487 within its cycle. But there's a warning, too. These are volatile markets. If the QRA does pull liquidity out globally, expect some quick pain here.
Right, high sensitivity to global flows. Finally, CAD pairs, the Canadian dollar. Our source suggests USD CAD is generally heading down. Part of the argument involves tariffs, saying they tax U.S. buyers and tend to weaken the U.S. dollar over time. So there's potential for USD CAD to go lower, maybe watching the 1.345 level. And AU CAD, the Aussie versus the Loonie, it's up about 100 pips recently, but seems a bit stuck. The expectation, though, is that it should go higher. Why? Because it's very sensitive to risk appetite. AUT CAD going up usually means global sentiment is positive. The riskier Aussie beats the safer CAD.
Yeah, and the report adds a key insight. Recent CAD strength isn't really about Canada itself. It's more about broad U.S. dollar weakness. That's an important distinction.
Okay, wow. So pulling all this together, what does it mean for you, the listener, trying to make sense of these markets? Our deep dive today seems to have laid out a pretty clear game plan for navigating what the report calls this inflection week ahead.
I think so. The main themes, the takeaways, they feel quite clear now. First, the QRA is the big wild card. It can genuinely set a trend in motion for the next 6, maybe even 12 weeks just by shifting liquidity. Huge impact. Second, the FOMC meeting. Even without a rate change, it resets the clock. That 6-week cycle framework becomes really crucial for how you scale trades in and out. And third, NFP and GDP. That's the growth verdict. That defines the Fed's next move, so you've got to be ready for sharp, sudden reactions around that data.
And the overall strategy seems to be twofold for this specific week. First, play defense with what you already have. Be ready to cut positions if key levels break. Protect your capital. And then be ready to go on offense later. Scale into new trades, but only after you see a clear signal, a clear inflection point emerge from these events. This week, the report stresses, is really about gathering intelligence and managing your P&L, not necessarily making heroic new bets.
Which brings up, I think, a really important question for you to think about. In a world where all these financial events are so tightly linked, where money can shift so dramatically, how can understanding these specific mechanics, this interplay we've discussed, how can that empower you? Empower you to make more informed decisions, rather than just reacting to headlines after the fact. It's about shifting from just watching the market to really understanding its currents, wouldn't you say?
Absolutely. It's about proactive comprehension. You now have the insights, the data points to help you decide when to push that button or when to hold back, and maybe how to time those global equity bets, aiming for what the report calls the sweet spot. Until next time, keep learning, keep exploring, and keep deepening your understanding.